Good morning. My name's Paul Nicol, Managing Partner of GFM Wealth Advisory. On this morning's podcast, I'm joined by Jai Mirchandani. Jai is the founder and the portfolio manager for ELM Responsible Investments. In this morning's podcast, we discussed with Jai investing in a responsible and sustainable manner, but we also spoke about quality growth investing and the opportunity that exists for investing in quality growth at this stage of the market. We hope you enjoy this morning's podcast. Before we get underway, today's podcast is general in nature and not specific to your circumstances and should not be considered personal advice. Morning, Jai. Thanks for joining us today.
Hi, Paul. Thanks for having me.
Terrific. So, Jai, let's start with you explaining your background and why you started ELM Responsible Investments.
Sure. I've been in markets for a long time now, almost 20 years. And I first started out trading equity and derivatives here in Melbourne. And that was great for a while. But then my goal was always to get into the deep fundamental analysis of companies and really get close to the valuation and make investments based on that. And so I then moved to the UK, did my master's degree at LSE in finance, economics, and accounting, and worked in M&A for a little bit in London, and came back to Australia and worked for a firm called JCP Investment Partners, which was at the time one of the largest institutional fund managers in the country. We had clients like the Future Fund and the big large institutions as clients. So I got the experience of following their process, which was around investment rigor. And that experience really sort of shaped my view on investing. And in 2019, JCP returned $4 or $5 billion back to clients, closed up shop, and I was thinking about what to do next. And I traveled the world and went to Europe and met with some of the leading sustainable investment fund managers and thought, you know what? I was 35 and had a young family and really was passionate about sustainable investing and saw what was done over there in Europe and realized that we didn't have strategies that were focused on innovation and positive change. We had a lot of ESG funds, so that's strategies that excluded certain things, focused on governance, which is fantastic. But if you're a fossil fuel company, for example, if you had good governance, you'd still be invested. I wanted to set up a strategy that was focused on companies driving that positive change. So I came back, and that's when I set up ELM.
Terrific. So talk us, you just mentioned before the investment process that you had learned at JCP. Can you talk us through the investment process of ELM?
Yeah, of course. What we did when one of the first things we did was acquire the intellectual property at JCP. So, the intellectual property and the investment process had been run for decades for the institutional clients, which we then acquired and improved upon. So at the core of it, it's about understanding businesses, looking for what we say key value drivers. So the 3 or 4 really important factors that are going to affect a company's valuation. And what that helps with is, there's so much noise out there. There's so much news flow, and it's hard to decide what is important and what is not. But if you've done the work and you've identified the handful of variables that are really, really important for a company's value, and you focus on that and you model that out, you think about it in a probabilistic way, so based on scenarios, you can shut out the noise and focus on what matters. And then we build a valuation model around that. So for us, it's really about returns, risk, and positive skew. So we want companies with asymmetric upside. And our view is that, how do you get that? They tend to be the companies that are high quality, run by incredible management teams, long runway for growth. So really large total addressable market. And those total addressable markets are there because these companies are investing in innovation.
Mm. So at the core of ELM's DNA is sustainable investing. So I'm very keen to learn from you. I want you to explain how you guys, or what your sustainable framework is, and then how you combine that with the investment process, which to my eye looks quite unique.
Yes. So you're right. Sustainability is at the core of of what we do. Um, Sustainability and investment rigor are equally important for us. As I said before, it's not just about excluding certain companies. We really want to identify the companies that are driving positive change. And we use a method called the Impact Management Project's 5 dimensions of impact and their classification system. And a lot of venture capital and private equity firms do that. And it's a way to measure the level of positive change or an impact on a particular by a particular project or an asset, and it standardizes the level of impact. So you can then compare apples and apples, and across sectors. So we've taken that process and applied it to public equities. It's a lot more complicated in public equities because there are a lot more factors. These companies are much bigger, lots of different stakeholders. But we have a process where we go through, and measure and quantify the level of positive change and impact a company is driving. And we combine that outcome with investment rigor that I spoke about before, which is focused on returns, risk, and positive skew.
Yeah. Okay. So going back to the investment process, you used 2 key terms before: quality and growth. So I don't want to pigeonhole the way you approach investing at ELM, Jai, but I will describe you as quality growth.
Yeah.
So this is an interesting time for quality growth. I guess where I'm going with this question is that that it hasn't been an easy period to be a quality growth investor. It sounds like an oxymoron. You would think quality growth would always perform well. But how do you see, right here as we're sitting here in April of 2026, how do you see investing in quality growth right now?
No, you're right. We see the market is offering us plenty of opportunities right now because of the de-rate that's happened. And as you go through periods like this every few years. And from my experience, you want to take advantage of these opportunities. And we're seeing that right now. And if you think about, well, why is this happening? We had a few years ago interest rates starting to increase, and that really affected the quality growth space. But more recently, that started to moderate or turn back. So there's some stabilization there. But I'd say about 6 to 8 months ago, we then started getting worried about the AI disruption fears on a lot of these companies. And our view is that, we've been through the work, we've analyzed the companies, that yes, AI is going to disrupt a lot of companies, but also there are a lot of companies that are going to be able to use AI as an advantage. And, their total addressable market is going to be increasing rather than decreasing, which is what the market's expecting or assuming right now. So as a quality growth investor, we're being very selective, identifying the most innovative and impactful companies, the highest quality companies that are investing in these opportunities. And we'll start seeing it play out over the next few months, how that's tracking. And our expectation certainly is that, some of these companies are going to do incredibly well.
We'll get to some portfolio positions in a moment, Jai, but I guess I just want to delve a little bit quicker. You said that this part of the market's derated. In effect, we've seen pockets of the market fall quite significantly of recent times because of the fear of AI. But this seems so broad brush. You mentioned that you're looking a little bit deeper and seeing whether AI is the friend or a foe of these businesses. But why does the market become so broad brush in its approach of selling it down? Why is it so indiscriminate? I know you don't have the exact answer for that, but is there some sort of context that you can give to this?
I think As you know, the market's becoming more and more short term.
Yep.
And so the focus on what is going to make you the most money in the next week or 2 weeks or a month, we're more interested in what's available over the next 3, 5, 10 years, generational wealth creation opportunities. And one of the, I guess, the arbitrages that we're trying to exploit here is that time arbitrage because we're patient and we've done the fundamental work. We're riding through that. We're happy to ride through that short-term volatility because in our view, the short-term price fluctuation is not risk. That's just volatility. Risk is the permanent loss of capital and not achieving that capital appreciation over a long period of time. So, I think that's one factor, that the market becoming short-term. The other factor is the use of ETFs and thematic ETFs. If you look at the software ETF, for example, the IGV, and the global one, you've got companies from Microsoft to Palantir to Adobe to Salesforce to everything smaller. So AI is going to affect all those companies differently, but investors or traders are using that ETF to play the narrative. And so that then creates the opportunity for, investors who are going to look through each company stock by stock and judge the company based on its merits and what they're doing and whether, they're going to become beneficiaries of AI as opposed to a loser in this new economy.
Yeah, great answer. I think your point about the shortism of the way people view markets and particularly Jai, you guys, I think one of the things that GFM is very there are many reasons why we like what you do, but you think like business owners.
Exactly.
You're not thinking for the next 1 or 3 months. You're thinking well beyond that. And I think if you can think like that, that's where the opportunity set opens up.
Exactly. I couldn't agree with you more. I look at some of the most successful, wealthiest people around. They've been involved in business for many, many years. Very few people are trading in and out. And so we've taken that learnings and gone with, okay, the best way to generate that wealth creation is by owning the highest quality businesses run by incredible management teams with an incredibly long runway for growth. And that's what we keep doing.
Right. So you guys run both a global fund and a domestic fund. Today we're focused on the domestic fund. I'm very keen now to look at your portfolio positions. So when I think about your process and when I think about your sustainable investment approach, I think that you're going to be heavily exposed like we've spoken to now around technology. I think about healthcare. I think about climate. Can you talk us through some of the positions you've got in the domestic portfolio?
Yeah, exactly. So, healthcare, technology, and climate are three of the big sectors that we're invested in. As we, Pro Medicus in our Australian fund is one of our biggest positions, and it's been a great contributor to performance over a long period of time. And we're really excited about that opportunity going forward. I'd say from about October last year, it started derating quite significantly. And, our process is we have a valuation and a risk that we invest based on. And as the stock price increases, and the expected return narrows, our portfolio platform would flag to us to start trimming if all else is equal. So if nothing has changed. And certainly, our view last year was that the business was going incredibly well to expectations, but the expected returns had come down. So we were trimming and investing elsewhere. And then likewise on the way down, nothing's changed in our view. And we see the opportunities ahead there. They're for those of you that don't know, they're a technology company that sells a software product to radiologists and healthcare and hospital groups. And it essentially enables radiologists to look at scans anywhere. And you've got that, I guess, leading technology, but also the way they they deploy the software across the hospital network is world class. They're one of the fastest deployers of the technology when compared to peers.
So, are they selling just domestically or globally, John?
They're mostly international. So their biggest market is in the US. So if you think about the total addressable market in the US, it's about 600 to 700 million scans, and they've got about 10% or so of that market, and they continue to grow and increase. And over the last month, they've announced some major contract wins as well. So we expect that to continue. And they're growing into Europe as well, and so that's a new market for them. But what the amazing thing is, they're also incredibly profitable. The profit margins are one of the highest in the world when it comes to software companies, and their revenues is growing. So if you think about the fundamental risk of this company, there's no leverage, there's no debt, they're net cash. It's founder-led, based in Melbourne. We see the opportunity for growth to be incredible, and the business is functioning and operating at an incredibly high level.
And do you think AI can disrupt that business?
No, I mean, our view is that the company is an AI beneficiary. So it's a regulated industry, obviously, and that in a way it's one of its competitive advantages. It's been operating in this space for decades, and we're just not going to see an AI startup come and replace Pro Medicus. And our view is you've got to dig a little bit deeper and think about, okay, what is the value that Pro Medicus is adding? It's embedded in their customers' workflow. And so within that workflow, the company's starting to introduce other AI products and features from third parties as well. So they're moving more towards the Apple iStore model, where they're going to introduce other AI features within the platform because they've got the engaged users already. And rather than taking the risk on what the next, best app is going to be in AI, they'll integrate what they believe to be the highest quality and value to their customers, and then generate revenues that way. So we think it's a much smarter way of operating, and a way where AI is going to be a tailwind for them. Not just from that business model, but also in terms of the efficiencies that we can expect within the radiology sector, where AI is going to improve the productivity of the workers, and that's going to lead to more scans coming through their system. So, based on all of that, our view is that the fundamentals have in fact improved.
Yeah, fascinating. So, just on Pro Medicus, you run quite a concentrated portfolio. We've seen a significant derating of the share price. How strong is your conviction at the moment on Pro Medicus, and have you been buying any more of that?
We have been buying. So as I said before, we do trim and increase our weight and take advantage of volatility. But that's, I'd say, 10-20% of the value creation that we can expect from the fund. Most of the value creation comes from the really long-term opportunities in holding these incredible companies. And, yes, we have been buying Pro Medicus and increasing the weight as the stock price has fallen. It's about 9% of the portfolio now.
Yeah, fantastic. So we've focused on a healthcare stock. I don't want to immerse technology and software and say that they're identical, but I think I am keen to focus on software, Jai, because I think software has been in the eye of the storm of the recent sell down in that part in the technology part of the market, and particularly the fears of AI disruption. So how are you thinking about the sector, and do you have any software companies in your portfolio?
Yes, we do have software companies in our portfolio, and our view is that we're bullish AI. We think that it's transformational technology for the economy and all companies. have to be aware and alert to it. And many software companies will be disrupted. And even if I look at our own business, we had multiple software vendors, and we've noticed that the thin software product, the single-use product that was overpriced, served one calculation function or some just a single utility. We've stopped subscribing to those types of software. And that makes sense in the world of AI.
Of course.
However, you have software companies that are much more embedded in their customers' workflow. They have an incredible amount of data.
Yeah.
And as you know, you need data to train the models in order for it to work efficiently.
Of course.
So that in itself, that's an advantage that these software companies, some of these high-quality software companies have. But on top of that, these companies need to keep investing and reinventing themselves.
Yeah.
And we are seeing that today. So if you look at a company like Xero or Technology One or WiseTech, they are introducing new pricing models, really reinventing their entire business model around AI. And the question is, well, has this happened before? And the answer is yes. It happened, when the world went from on-premise to SaaS.
Yep.
There's a lot of concern about whether some of these companies could make it through to the other side. But the highest quality companies did, and it was a generational buying opportunity for the right companies. We saw it again when the world went from desktop to mobile.
Yep.
There's a lot of concern about companies like Car Sales and REA Group as to whether they could monetize in a mobile-first world. And of course, they were successful in doing that because they invested in that technology and that platform shift. AI is much bigger than those changes in a way, but also not. And I say not because the data sits in the cloud, whether you're an AI or not. So that's already there. So which wasn't the case when we moved from on-prem to the cloud 20 years ago. So our view is that for the incumbent companies that are forward-looking, well-run, they've got the data, they've got embedded workflows, sticky customers, and they're performing that mission-critical task, connected to multiple stakeholders. So if you're a company like Xero, you're connected to the ATO, you're connected to payroll, you're connected to HR, accounting. It's incredibly difficult to rip that out. So yes, we do own software, but we're very selective.
And the companies that you own at the moment, I think you mentioned you own Xero,
Yes.
You own WiseTech, and you own Technology One.
Yes, that's right.
Great. I want to talk about another company that's prominent in your portfolio, and that's Infratil.
Yes.
The other day you mentioned to me that Infratil is the compounder that most Australians underestimate.
Yes.
I'm going to go a step further. I think it's the investment that most Australians haven't even heard of.
Yes.
So I'm really keen for you to explain who Infratil are and why you guys own them.
Sure. So it's a holding company. That's the best way to look at it. Externally managed. So Infratil, the company listed on the stock exchange, has all the assets, but the management of the assets is done by Morrison, which is a New Zealand financial services firm, incredibly successful, long-term thinkers. And the focus of the assets right now are in energy and renewable energy and digital infrastructure. So they're the two areas that are really aligned with what we stand for as well. So philosophically, there's an alignment there. But on top of that, they're incredibly good at recycling capital. In 2016, they had a stake in a renewable energy company called Tilt, which they then sold a few years later to an institutional investor and generated an IRR of about 35% per annum over that time. And what they did then was that they recycled that capital back into the business. And then they seeded a number of different renewable energy platforms around the world. So now they've got a renewable energy developer in the US called Long Road Energy, in Europe called Galileo. They've also set up a new one in Australia called Mint.
Yep.
So their strategy is seed these companies in the most transformational and important sector of that we're in right
Yep.
now, renewable energy.
Yep.
Seed them, grow it, and then sell it to a investor who's much more interested in that stable stream of cash flows, and in the process generate a significant amount of wealth for its shareholders. So we've got that on the renewable side. And on the data technology side, they're a investor in a company called CDC, which is the largest data center operator in the country. They've dealt primarily with government and secure clients, highly sensitive clients, and that's really, I guess, established them as the leader in the space, as opposed to other data center providers who might not build to their quality. So we're really happy with that investment. They've got a number of other smaller investments, but to be honest, those two investments are the most important for Infratil.
Can I just focus on digital infrastructure and then climate? I think I'm
Sure.
not telling you anything you don't know, Jai, but but we understand that digital infrastructure, let me say data centers, can be very big chewers of energy. So Infratil, as having such positive climate or energy or climate kind energy assets, the data center side of things, how do they match the two together?
Yeah, no, great question. And I was on their on site a few weeks ago and had the opportunity to look through their data center and chat with the founder and the team there. And it comes back to the founder's still running CDC, and it comes back to his vision of making the data centers from 10 years ago, 20 years ago, still with a mindset of sustainability from back then. So in terms of water usage, they're the only ones that I know of in the world that uses a system that can reuse the water internally. And that clearly has a strong environmental benefit there. Yes, around the world, we're seeing the strain that data centers is putting on the grid. But what we're also seeing is that the new energy that's coming on board as a result of the increased demand from data centers is coming from renewables.
Okay.
So in a way, our view is that data centers or AI factories, because of their energy intensity, has been a catalyst for renewables to really shine.
Interesting.
And so our view is that over the next 3 to 5 years, as we build out our infrastructure here, we will see more renewables coming in. And we're certainly seeing that in the US. And we expect that to continue.
Yeah. So I just want to zoom out a little bit, Jai. You've made some compelling you've certainly got some compelling thoughts about the value that might be in some of these software stocks at the moment, or might be available in pockets of the healthcare sector. And you've spoken about Infratil, but I guess not that Infratil has drawn down recently, but there have been quite and you also spoke about interest rates falling being a trigger in the fears around AI. So we've certainly seen some significant drawdowns in parts of the market of recent times. So if we can just zoom out a little bit, I'm really keen to know how you think about risk management and how you manage downside risk and volatility in your portfolio. The market feels like it's, more volatile than ever. I don't know how to really say whether that statement's perfectly accurate or not, but I'm just really keen to know how, on behalf of our clients, how you view, how you do your best to manage downside risk and volatility within the portfolio.
Sure. So for us, risk is the permanent loss of capital over
Yep.
the long term. And so, you know, we come back to our models and to the key value drivers, and we're continually questioning those assumptions. And so, if anything has changed in those assumptions, then our valuation will change. Then that would then trigger a change in the portfolio. If nothing's changed and we see a drawdown, then we see that as an opportunity. Now, yes, we run a concentrated portfolio, and so it is much more volatile than the broader fully diversified, S&P 500 or the ASX 300. And it does behave very differently to those portfolios, but our strategy is set up as a satellite to the core.
Yeah.
And that's the first thing I want to make sure that we kind of make clear. But even though we're concentrated, we are diversified across multiple sectors, multiple themes. And if we look at a company like Pro Medicus and Infratil, two totally different drivers there.
Yep.
One's very asset heavy. Capital management's really, really important. Pro Medicus is a much more technology focused company, but both profitable. So we do get diversification there. And that helps with the drawdowns. And then the other, I guess, the final point to mention is that the process where we are continually reviewing our portfolios. If we're looking at market information to see if the level of volatility has increased or decreased, how that impacts our valuation. We're looking at not just company-specific information, but market data and market information. So, that feeds into our interest rate assumptions, and that then shapes how we address our portfolio. But it all comes back to the valuation framework around expected returns and risk and skew, which we're always trying to maximize.
Great. So you just mentioned something before that I want to delve a little bit deeper. So I can certainly see how you would fit in a client's portfolio that has the same value set of wanting to invest in a responsible and a sustainable manner, as is the DNA of ELM. But you mentioned before core and satellite, and you felt like that your strategy, the ELM Australian Share Fund, would be better as a satellite rather than the core. Can you just explain that a little bit more to us?
Sure. And we run a concentrated portfolio, and everyone's got different risk thresholds over the short term.
Yep.
For me personally and my family, we're fully invested in our strategies because we believe in it, and we want that skin in the game and be together with our investors. But in saying that, as you know, all your clients have different needs and requirements. But our strategy is concentrated. It is therefore more volatile.
Yep.
However, the trade-off is that over the long term, our expectation for returns is going to be different and higher in our view. But the short-term volatility we see is the cost of doing business to participate in some of these incredible companies.
So I'm really putting your business owner hat
Sure.
on, and then looking at the way you're investing right now within the ELM Australian Fund. How are you feeling about the next 3 to 5 years? What excites you most about being an investor the way you're investing right now?
Look, there's so much pessimism around quality growth, particularly in the software space, and even healthcare too. It does appear that sentiments really come out of these sectors, and I would say sentiment is often historically always been short term. It changes. It could flip to the other side really quickly. So we don't invest based on that. We invest based on the fundamentals, and the fundamentals of our companies are incredible. For the fundamentals of a lot of the companies in the quality growth space is incredible still, yet the prices come down. So we view that as a fantastic opportunity for long-term investors. yes, you've got to be selective because AI disruption is real. And so you want to be on the right side of that. So, I've said it before, rather than in the software space, rather than going into a broad-based ETF, our view is that it's much more important and better to be selective and understand which companies are likely to be beneficiaries over the losers. So over the next 3 to 5 years, we're really excited. We see a lot of opportunities out there, and we're going to keep following our process to invest in the highest quality, sustainable, and most impactful companies and hold them for the long term.
Great. Jai, we've run out of time. I've got to say I've found today's discussion particularly fascinating. We, GFM, firmly believe in what you do and the way you go about it. So we hope you're right. We hope the next 3 to 5 years is particularly exciting for you and for your strategy. And we genuinely appreciate the time you've spent with us today talking about what you do.
Thanks, Paul. I had a great time.